Hi everyone, this is Anders Ibsen with Windermere Professional Partners, managing broker of Anders Ibsen Homes. Now, it's not news that it's a fundamentally different economy. Historically high inflation, and higher interest rates, and higher costs overall are making it harder for everyone. And this also includes, among other things, investment properties. Maintaining or remodeling a good rental property has gotten even more expensive due to significantly higher costs like materials, labor, permitting, and who knows what else. But what's also adding pain to this for many investors in our community is the tax implications. Because for all the money you're spending, you're not necessarily seeing a commensurate rise in your tax savings. Now, before we dive into this further, I am not a CPA. I am not a tax preparation professional in any way, shape, or form, and you are absolutely encouraged to seek someone out who can explain these issues in far better detail than I can. I'm just talking about my own experience and the experience of my clients. Now, with that being said, here's a little bit of Tax 101 when it comes to rental properties and the savings you can realize by improving them. Generally, it comes to one of two categories. There's maintenance, or there's what's called capital improvements. Maintenance is exactly what it sounds like. It's usually a one-off, like hiring a handyman to fix some rotten wood trim or a fascia board, or maybe the washing machine in one of your units breaks and you hire a technician to fix the washing machine. That's maintenance. And usually with maintenance, you can write off all those expenses in the same tax year. Capital improvements, on the other hand, are significantly different. A capital improvement is a more substantial update to your property that increases the value. So think of a kitchen remodel, for example, or a new roof or new plumbing through your units. And with capital improvements, you absolutely may not write off all of those savings in the same year. If you spent $50,000 remodeling a kitchen in one of your duplex units and you tried to write off all that money the same year, the IRS would have a word for you. What you have to do instead is what's called depreciation, which is estimating the expected life of that component or your property as a whole, and then breaking down the cost basis of that upgrade over that period of time. The default is usually about 27.5 years. So you can spend an arm and a leg renovating your property to make it more valuable, and unfortunately, you're likely not going to see a lot of those tax savings for some time, just due to how the rules work. And this is problematic because as investors, we know that present money is always more valuable than future money. So what to do about this? Fortunately, there is such a tool, and it's what's called cost segregation. Cost segregation is highly technical, so we're not going to dive too much into the weeds there, but on a high level, what it is a federally recognized tool that a lot of real estate investors use to speed up depreciation on some of the components to your property. So let's come up with a hypothetical. Let's say that you own a fourplex and you completely refloored it. You installed brand new carpeting or LPV or something throughout the units and the common areas in your property. Let's say you spent $15,000. Under the default depreciation, you would have to spread that out over 27.5 years, and for $15,000, that's $545 per year in tax savings. That's negligible. That doesn't really do anything for you. But if you used cost segregation to speed up the depreciation of your flooring into, say, 5 years, just because that asset is only going to last that long, then your savings jump up from $545 per year to $3,000 per year. So a 450% increase just by cost segregating that one component. That's significant. And what you do with those tax savings is totally up to you. That's money that you can spend further improving that property, making another investment, or maybe saving the cash for a rainy day. Now, as I'm sure you've gathered, this is highly technical stuff. You should not try to cost segregate your own property. Thankfully, there are highly reputable firms in the area that do specialize in cost segregation, and they can do a great job helping you realize those savings. And it should go without saying, but if your finances have gotten so complex that you're cost segregating a rental property, hire a good CPA. Do yourself a favor, save yourself a lot of pain down the road, and don't TurboTax your fourplex. Tax season is coming up, so if you are interested perhaps in a referral for a good cost segregation professional or just a good CPA, or if you're just curious about what the market is looking like for income properties, you're always welcome to reach out to me anytime. Call, text, or email, and I'd love to hear your feedback or your questions. Take care, thanks for watching, and Happy New Year.